trough in that liquidity cycle was October of 2022, and the next peak is slated to be sometime late in 2025. And as I said, I think there are three major demands on markets or on liquidity over the next year or so. One is,
like, a lot of people are insanely bullish right now. That's at least like my anecdotal evidence that I have. And this then again is usually, I would argue, also some sign of caution.
we're not risk off yet, but we're basically, if money is being used to roll over debt, it's not being used to buy, technology stocks or Bitcoin or whatever else. And that may be the problem.
Meet Michael Howell, the CEO and founder of Cross-Border Capital, a leading independent research and investment firm based in London.
With over 40 years of experience in financial markets, Michael is an expert in liquidity trends and capital flows, helping institutional investors navigate the global financial landscape. Before founding Cross-Border Capital, he held key positions at Salomon Brothers and Baring Securities.
What we've got to recognize here that many things in a world of debt refinancing are topsy-turvy. They're upside down. It's like living in an Alice in Wonderland world compared to what you're used to. But that's the reality. We've got to accept that. So liquidity and debt have this partnership where they both rise together. And therefore, what we're seeing with a rising debt environment is a rising liquidity environment. If you want to invest over the next 25 years and you expect government debt to increase significantly, and I would argue that's inevitable because of aging demographics, then you've got to expect debt to rise, liquidity to rise, and the price of gold and Bitcoin to rise over the medium term.
Hey guys, so I'm back with another episode. This time I have somebody from the UK, if I'm not mistaken. It's Michael Howell, better known as Cross-Border Capital on X. I've been following him for quite some time. It's been very interesting to listen to other interviews that you have given. Just such a unique perspective, obviously, with all the background that you bring. And it's just amazing to have you here today. Hi, Michael.
Hi, Pascal. Very good to be here. There's interesting times, many things to talk about.
Yeah, exactly. Yeah, that's kind of cool. And for the first time, I can actually do an interview a little earlier because I think you and me were both in Europe, so quite close in terms of timing. Usually, I do these episodes with people from the States, and then it's me like doing this at the night. But now this time, really nice, that we are quite closely connected, so to say, also geographically. So maybe if you could just quickly give an introduction to yourself, where you're coming from, and then also what your main topics are, this would be great.
Yeah, sure. Cross-Border Capital is an advisory company. It's been going for about 25 years. Prior to that, I was in investment banking. I started off at Salomon Brothers, the US investment bank. Salomon Brothers, for people that don't know, pretty much was the fixed income markets in the 80s and early 90s. It was the dominant force worldwide. Salomon Brothers probably has got the reputation of having more Nobel Prize winners than, and I exclude myself obviously from that, in the film than anybody else. People like Myron Scholes, Robert Merton were working there, and it was very research driven. We needed to understand how markets worked. It was a question of watching money flows, trying to put that into a sensible framework. And out of that whole research effort, this concept of global liquidity kind of emerged. It emerged in the mid-1980s. It was at a time when financial markets were internationalizing fast. It was a period where cross-border capital flows were nascent but beginning to accelerate. And it was something which was a valuable tool when Salomon Brothers was trying to understand its proprietary trading. It did vast proprietary trading across the world, but it needs to understand those money flows. And that's pretty much how the research effort started. And ever since that time, we've been researching in detail the direction of how money moves in the world economy.
Yes, exactly. Yeah. Thanks for your background, and certainly helpful. I mean, that's exactly what I would like to talk to you about today, because as you said, liquidity, it's been so on everybody's mind, and also it's been quite essential in terms of what's driving markets. And you probably as one of the few has certainly been instrumental in bringing this topic to people's attention as of late, or as you say, even since a few years. But I feel like more people are waking up to this idea that it's really this essential. So maybe just to kind of set the context, because what I want to talk to you about today is really like, it's Q4 now in 2024, especially, again, I was talking to a friend recently. He showed me his S&P 500, investment. He was like, wow, I'm up, 18% since I did this. It's crazy. Everything is going wild. You have to be invested in the stock market. And then obviously, if you look at gold and Bitcoin, it's just a similar and probably a greater magnitude in terms of performance. But like a lot of people are insanely bullish right now. That's at least like my anecdotal evidence that I have. And this then again is usually, I would argue, also some sign of caution, especially if it's people that are usually not that close to the markets and then are just like this really bullish and showing me these screenshots of what they have been doing lately, So I think in order to know if this can be extended and where we are going, again, I think it's really important that we look at what's happening with global liquidity and liquidity in general. So maybe if you could kind of explain again why liquidity is so instrumental in driving today's financial markets, and then also kind of where we are at in terms of liquidity, in terms of the situation and the outlook for 2025. Yeah, but if we could start with the first question, that would be nice.
Sure. Okay. Well, let me first of all describe what we mean by liquidity, because liquidity means many different things to many different people. What we try and do is to hone in on a strict definition of liquidity to make it workable. So the thesis can be proven or unproven, but you need a concrete concept really to understand and to test things by. So what we're looking at is money that is flowing through world financial market. Let's be clear about that. It's not money that's in the real economy. If money goes into the real economy, clearly it leaves financial markets, so that's not a good thing. So what we've got to try and understand and try and calibrate is the flow of money through world financial markets. And that's what we set ourselves the task to do. And for the last 25, 30 years, we've been creating databases that actually look at each country's money flow through their financial markets. And it's that which we aggregate into a global liquidity concept. So that's point number one. By the way, all this is articulated in detail or described in a book that I wrote 2 or 3 years ago called Capital Wars, which is published by Palgrave. In that book, we detail the whole methodology of liquidity. We give data and we show how it works. So that's for reference. In terms of why liquidity is important, it's important, if you like, maybe from an obvious standpoint, that people need money before they transact. So money that's going through financial markets is basically transacting in financial assets. But I want to go a little bit deeper than that and try and explain 2 features of financial markets that are really important to understand. The first concept is to throw away the textbook understanding that capital markets are there to raise money for new capital spending. That's a very nice idea. It worked for a long time, but it's not really the world that we live in anymore. There's not a huge amount of capital spending going on. Maybe there's sort of, sudden appearances of a burst of capital spending, but the years of strong capital spending were really over in the sort of 50s, 60s, maybe 70s. Most capital spending now is undertaken in the East, in China. It's not directed through capital markets. It's state organized. Interest rates don't really matter in that context. It's not a question of raising interest rates and curtailing the business cycle through increasing the cost of new capex. What capital markets are really about now is huge debt refinancing mechanisms. Something like 3 out of every 4 transactions that go through financial markets today in the advanced economies are basically debt rollovers or debt refinancing transactions. And that's important to understand. In a world where you're doing debt refinancing, rolling debt, it's not interest rates that really matter so much. It's the capacity of the system to provide liquidity to roll over debt. So balance sheet capacity is the crucial thing. And that's really what we're talking about when we're talking about liquidity. Now, if you don't get the balance sheet rolled, you get a default and you get a refinancing crisis. Every crisis that you can think of going back over the last 2 or 3 decades has fundamentally been a debt refinancing crisis. So we need to look at the potential disconnect between debt and liquidity, and that's really the main focus that we have. Now, the second point to make is that if you look at the dynamics of those two factors, debt is exponential. This evidence what's happening with debt GDP ratios across the West. They're growing rapidly, particularly public debt. And what you also got alongside is liquidity, which is largely cyclical. So the fact is that one concept is exponential, one is cyclical. The two are rarely likely to meet. And when they disconnect, you get a financial crisis. So that's why it's important to look at both. Now, there's a slide you can put up which actually shows the global liquidity cycle as we measure it. This is in index form, and it basically illustrates the movement since the early 1970s of global liquidity. It shows an index that ranges between 0 and 100. It's got a mean of 50, and that index of liquidity is measuring the momentum of liquidity flow through world financial market. On top of that chart, we've basically overlaid a sine wave just to emphasize that we're not cheating here, that we're forcing a fit. That sine wave was actually put in place in year 2000, and for the last 25 years, it's been extrapolated forward. So what you see is what you get, and it's lining up pretty nicely now. The trough in that liquidity cycle was October of 2022, and the next peak is slated to be sometime late in 2025. Now, the issue that we highlight when I come back to this whole point about debt growing exponentially and liquidity being cyclical is there is a growing tension next year, which is being raised because of something called the maturity wall. Now, the maturity wall is a name which describes the upcoming refinancing burdens of more and more debt that is being thrown back on the market to be rolled over. And that is occurring because in the period of the COVID emergency, interest rates were pushed down to almost zero levels. And what that meant was a lot of corporations and households and governments too refinanced at low interest rates. And that low interest rate debt is coming up for renewal really in the next 2 to 3 years. It begins about the middle of 2025 and then starts to peak sometime around 2027 or thereabouts. So what you can see is a huge demand coming from financial markets for refinancing that will basically detract from current asset price gains. If money is being used to roll over debt, it's not being used to buy technology stocks or Bitcoin or whatever else. And that may be the problem.
Yeah, exactly. That's very well said in the end. Like it's always wherever money goes, and you can't do two things at the same time probably. But I want to go deeper on this later on as well. But I would just kind of hone in on this concept of liquidity with one further question, because like at least among laymen and even sometimes economists, you see people just focusing on global liquidity, and then you have like global M2, like all the bank liquidity that's out there. And that's where they kind of infer whether liquidity is ample or it is not, And I was just wondering, I think you are doing it, well, not differently, but you have like other things that you're looking at. I think you're arguing that M2, the global M2, liquidity aggregates that like a lot of people are pointing to are not the entire picture. Is that correct? And if so, kind of like what else are you looking at to really assess this balance sheet capacity that you were referring to?
Yeah, absolutely. I mean, let's drill into that data and try and clarify what we mean. Many people have spoken or speak about global liquidity, and they can mean central bank balance sheets. I mean, that's a very common definition of global liquidity. It's a wrong definition, but nonetheless, let's stick with it for a moment. Central bank liquidity is of the order of about $35-40 trillion. So it's not a small sum. It's a sizable amount of liquidity. But in the context of the world, our global liquidity aggregates are something like 175-180 trillion. So central bank liquidity doesn't really do it. It's a part of the picture, but it's not the whole equation. What you need to look at is the difference is what the private sector is supplying. And the private sector is doing that really based on collateral. So almost all lending, particularly lending in financial markets now, ever since the global financial crisis, is not based on trust, it's based on collateral. And you need to post collateral. And by collateral, I'm thinking here of government bonds, particularly U.S. Treasury bonds, also German bonds, Swiss Confederation bonds probably used as well to an extent in this picture. Think of an analogy with a home mortgage. That's collateral, against your real estate. But all lending now is principally collateral based. Now, on that basis, what you need to understand is something called a collateral multiplier, and that collateral multiplier will actually raise the value of collateral into liquid lending or liquid credit. And it's that which we're really talking about, which fills that gap. Now, M2 doesn't do that because M2 is simply the retail deposits of high street banks. Now, if you believe that banks are the entire picture for the global financial system, will come quietly. Banks were clearly very important at one stage, and they dominated the system if you go back to the 1950s and maybe 1960s. But from the 1960s, as you got deregulation in the financial system, high street banks were eclipsed by investment banks, by other forms of financial institutions. The repo markets developed, explosively, certainly in the last 20 years. And we need to look at all types of liquidity, simply not what is vested in high street banks. And that is M2. So we've got to go beyond that. Our aggregates are much bigger, and liquidity extends generally across the financial system, not just in commercial banks or one-owned banks.
Mm-hmm. Yeah, exactly, and that's a great point that you're making, and that's also, I think, because what you're saying is resonating with so many people, because it seems to like a lot of people are looking at central banks, they're all looking at commercial banks, but that's like that's about it, and now it's becoming ever more obvious that there's like a shadow banking system, so to say, as well, just other players who have become quite monumental in providing, like as you said, collateral, and in that sense, and also refinancing capabilities, as well as then just liquidity overall. So that's very interesting to certainly have in the back of your mind when you navigate financial markets. But so if I come back to this maturity wall that you now mentioned, and it sounds like this debt refinancing needs, these are, I would say, sort of a signal that should kind of caution ourselves, because like it sounds like there is like demand for liquidity, as you said, for this refinancing, and once this is taken up by this, it can't be used elsewhere. But I also feel like it's not a one-type event, clear-cut date that we can say now this maturity wall is here and we're hit, and from there on we're screwed, So it's probably more of a process like that's emerging. But can we kind of already point to where this has started, or has it already started, or how do you think about this as an investor then?
Well, it's beginning, and I think you're absolutely correct to say that it's a process, not a single event. We're moving into a period where the demands on the pool of liquidity are growing. They're growing from a number of different areas. One might be conventional rising inflation. Another could be the greater demands that are coming out of China. A third could be the debt maturity wall. These are all issues. There is a slide a little bit further in the presentation that I gave that let me just describe now. This is a chart which looks at advanced economies' debt as a percentage of liquidity. What that shows is a line going back to 1980. It basically shows the ratio fluctuating around the level of about 250%. So let me just again say what that means. That's looking at the ratio of total debt divided by the pool of liquidity. And what I've done is I've adjusted that debt figure for the maturity profile of the debt. So in other words, you've got a normalized picture for debt here, assuming sort of homogeneous repayments. And what it's taking into account is the fact that you've got a growing demand coming up on financial markets from this debt. Now, you'll see if you look at that chart closely that the broken line, the dotted line that runs across that chart horizontally is drawn at about 250%. That is an equilibrium. Above that line, you start to see refinancing tensions. When the debt to liquidity ratio rises, it becomes more and more difficult to roll over debt, and therefore you get the risk of financial crisis. It is the debt liquidity ratio that's critical, not the debt GDP ratio that many economists quote. And so often in economics, basically people start to calibrate or produce statistics that are easy to gather rather than statistics that may be difficult to gather but are more important. And this is more important. Debt to liquidity is far more important than debt to GDP. And if you look at that chart more closely, you'll see at the below the line, when the debt GDP ratio is below 250%, there is an ample liquidity environment. What you tend to find is that below the line, you get asset bubbles forming. Above the line, you start to get financial crises emerging. And ideally, we track that line closely, but you can see there is a cycle. What we've had for the last few years is a period where there's been ample liquidity relative to debt. That is partly a function of the COVID emergency when liquidity was thrown in with alacrity by governments, and partly the fact that there was a terming out of debt by borrowers. What you're starting to see now is that debt rollover re-emerging alongside a period where liquidity is beginning to slow down because, for various reasons, but partly it's because the dollar is going up, partly it's because central banks have lost some of it, partly it's because collateral haircuts are rising because of volatility in bond markets going up. But the number of features are slowing down the growth of liquidity relative to this emerging maturity wall.
Mm-hmm. Yeah, it's very interesting. And I think what I can gather from what you're telling me is like, if I think about that, there are there's maybe more the trader type of person who tries to kind of time these things, obviously not to the point where it's always correct, but like, yeah, seeing, okay, we see that there's some more strain or potential strain emerging in the economy. And then you want to kind of play this, and that's exactly as you said, that's probably now a time where you have to look at these numbers. As you said, we're above the line, and that could kind of signal some stress that is coming our way. And then obviously, if you're that type of investor, yeah, you have to be cautious right now. And probably, I think I heard you say also, you can keep on partying, but you really have to be close to the doors, right? Because or maybe already start scaling out. And is that something that you would still subscribe to, right?
Yeah, I think absolutely. I mean, we're not risk off yet, but we're basically starting to think more prudently about 2025. And 2025 is going to be a lot tougher than 2024. I mean, from our standpoint, we've been very upbeat on markets, very bullish for more than 2 years now. So we're becoming a little bit stale in that regard. So we've got to start thinking about or recognizing the fact there's a cycle. And as I said, I think there are three major demands on markets or on liquidity over the next year or so. One is potentially embedded inflation. Inflation is higher than central banks are currently letting us know or stating it. It's not 2%, it's nearer 3.5%. That may not be the end of the world, but clearly it's a bigger figure than expected. You've got China, which is an uncertain economy right now, but China is effectively a dollarized economy, we've got to remember. And if China needs liquidity, it would take it away from the West. And then you've got this third point, which is the debt maturity wall. So these are challenges on liquidity that were not around in 2025. So in 2024, they're there for 2024.
Yes, exactly. They're now like emerging and it's clearly there. But then, as I said, like the second type of investor, and I'm curious if you would subscribe to this view as well, or like if you think that way, if you are probably a person who's not that close to the markets, probably not as close as you, and you don't have a mandate of managing other people's money, you just manage your own money, and then you're like, okay, I want to be invested because I know I have to be invested. And also exactly because of the reason that you described, debt is ever more growing. That's why debt also needs to be kind of refinanced, and then probably through debt monetization done through banks and central banks and eventually by the government, And if we know that we have this dichotomy between debt and liquidity, and every now and then, like liquidity is kind of maybe falling short, and debt is like increasingly almost infinitely growing, then we know in a long enough time scale, if these crises also show up, as we have seen in the past, like the powers that be, they need to be ready to intervene, and then exactly provide liquidity again to have some sort of backstop in the system. And that's why, again, it makes probably sense to be, if you are just a person, as I said, who's not really into this long stocks, long hard assets like gold and Bitcoin, and that's probably something that you would argue as well, right?
Correct. I think you've got to be cognizant both of the trends that are driving markets and the cycles. Markets are clearly very cyclical, but they're also experiencing trends. And what we're seeing is an increasing trend towards monetary inflation. Now, there's a chart that I've got in the presentation which basically illustrates that monetary inflation background. What it shows is something we call monetary inflation hedges, which is basically gold and Bitcoin. That's how we defined it, against global liquidity. Now, if global liquidity expands, by definition, that is a monetary inflation. Okay. I use the word monetary inflation because monetary inflation distinguishes it from high street inflation. Many people don't distinguish between those two concepts. It's very important. Gold is not a high street inflation hedge necessarily, but it's an extremely good monetary hedge. And what we're getting is a lot of monetary inflation and some, but not overwhelmingly, high street inflation. Now, on the chart, what it shows is a black line, which is our projections of global liquidity right from the mid-1970s to 2025. And the orange line on the chart is the market value of gold and Bitcoin. And that seems to track pretty closely that global liquidity trend. Now, there are clearly cycles in that picture. And I'm not going to dwell on the cycles right now. I'm just going to focus on the trend. And that trend likely is going upwards. And the reason it's going upwards is that it's explained by debt and the exponential rise of debt. As I said, debt needs to be refinanced. If it's not refinanced, you get sovereign debt crisis or refinancing crisis or whatever you like, but you get a financial crisis. And therefore, central banks and policymakers want to avoid that. So the way they avoid that is by basically expanding the size of the financial system to facilitate the debt rollovers. And to do that, you need more balance sheet, which means more liquidity. So liquidity and debt have this partnership where they both rise together. And therefore, what we're seeing with a rising debt environment is a rising liquidity environment. Now, clearly, there'll be cycles there when they don't exactly match, but the trends are lining up. And those trends are driving monetary inflation hedges higher and higher. And that's why gold and Bitcoin are going up. I'm not saying there's no cycle. I'm saying that there is a cycle, but there's also an important trend. And just think about this concept. Since year 2000, the stock of American government debt, Treasury debt held by the private sector, has increased by 8 times since year 2000. The price of gold has gone up by 8.25 times. So gold has actually tracked exactly. Now, you could have finessed over that period different cycles in gold and different cycles in debt, but the trends stand out starkly over that 25-year period. There are very few assets that have actually matched that increase in gold. And that's what we've got to think about in the future. If you want to invest over the next 25 years and you expect government debt to increase significantly, and I would argue that's inevitable because of aging demographics and the commitments that many governments have made to social spending, welfare states, etc., and increasing defense burdens, then you've got to expect debt to rise, liquidity to rise, and the price of gold and Bitcoin to rise over the medium term.
Mm-hmm. Yeah, that's so well explained, all these mechanics and how they exactly intertwine. Yeah, that's amazing. Thanks for this.
And what I should say as well on the chart, there is a dotted line, a broken line along the bottom of the chart, which is US CPI, consumer price inflation. And that line is supposed to distinguish between the monetary inflation in black and the broken line for CPI inflation. And therefore, what that's trying to say is that monetary inflation is very different from high street inflation. The two may move together, but what explains the difference? What explains the difference is technological breakthroughs, in other words, reduced costs, higher productivity. It could be lower oil prices. It could be cheap Chinese products that are dumped in the West. All these factors reduce consumer price inflation. If those factors are not around in the future, then what you're likely to see is high street inflation matching monetary inflation. For the last 20, 30 years, they haven't for those reasons.
Yeah, exactly. That's certainly one of the risks that's always lingering around. Exactly. If we don't have, like, as you said, technological innovation and China with coming with the cheap goods that could kind of compensate for this, for the monetary inflation that we see, you know. But I mean, I would like to also come back to this cycle, the current cycle, you know, and like, one of the arguments I hear from the bulls that still remain, or like at least like one bullish argument that they have is that, yeah, we've only just started this global easing cutting cycle, and that should improve global liquidity into the new year as well. So what is your view on this? Is it really that we are in this easing cycle? Are we still at the beginning, or are people getting this wrong?
Well, I mean, the first thing is people are getting it wrong. We've been on an easing cycle since October of 2022. There's no question about that. And that's why financial markets, which are a great barometer of monetary accommodation, have been going up for so long. That's the fact. Interest rates are not a gauge of monetary conditions in the modern economy. In actual fact, you could even argue that higher interest rates are actually a source of stimulus now rather than a drag on economies. And the simple reason is that the whole backdrop of the flow of funds has changed within the world economy. Just consider the US Treasury debt is high. If interest rates go up on Treasury debt, there is a huge transfer payment from the government to the private sector, household sector, and institutions, and that is paid for by taking on more debt. Quite simply, so the debt is discompounded. So every time interest rates go up, what you see is a boost to U.S. transfer incomes and U.S. incomes. So actually, paradoxically, in the modern world, raising interest rates is actually a source of stimulus, not a source of restraint. That's bizarre. People will scratch their heads, but that's the reality. Hey, so what we've got to recognize here that many things in a world of debt refinancing are topsy-turvy. They're upside down. It's like living in an Alice in Wonderland world compared to what you're used to. But that's the reality. We've got to accept that.
Yeah. It's very interesting that you're saying this, because I feel like if I talk to many like conventional asset managers and investment committees, they're still now all focusing on this cutting cycle, and they are really arguing, yes, this is going to bring up global liquidity again. And as you now like eloquently explained, this is just maybe not the case. And it's I'm just wondering, when is this going to filter through? Probably maybe in the next few years or even decades. I don't know. Like at some point, people need to adapt, because as I said, we have people like you and others who are stressing the fact that they might be reliant on old, outdated models, and it's just interesting to see, because I feel like a lot of investment committees are basing their investment decisions on stuff like this. We are now entering a global liquidity cycle in terms of easing and cutting by the more and more central banks. They're pointing to all these central banks that are cutting. So just interesting observation from the end.
The fact is that the price of money is not the rate of interest. Okay, that's the cost of credit. The price of money is the exchange rate. And that's what you've got to start understanding. So if the gold price goes up, which is the sort of price of money par excellence, what that's saying is there's abundant money in the system, there's abundant liquidity. If you get the dollar rising, that's saying that the demand for dollar money is actually increasing relative to the supply. These are things that we need to take into consideration. But what you're seeing, particularly in the dollar world, is an emergence of an issue that we've seen many times before in the world economy, which is an emergent bubble. And we've got to be very cognizant of that, because trees don't grow into the sky and bubbles don't inflate forever. And what you're seeing is an adjustment mechanism in the dollar that we saw maybe originally in Japan in the 1980s, but was carried through into emerging Asia in the mid 1990s, and got carried through to China after the GFC. These are factors that we've seen many, many times before, and they come back to capital flows. Now, the thing to remember when you're trying to understand the dynamics or the drivers of global liquidity is that cross-border flows are a very important element. Now, what we need to understand in this context is the dollar and really what's going on. And the fact that the dollar is going up is maybe contrary to what people have thought about in this upcoming Trump presidency, because Trump has been very vocal to say that he wants a weaker dollar, but the reality is the markets are giving him a stronger dollar. And I think the fact is that the markets are right, because the policies that Trump is enacting are basically pro-dollar policies. And I rather suspect that proposed Treasury Secretary Scott Bessent is actually a hard money man. And if he is a hard money man, what we may be seeing is that Jerome Powell's tenure at the Federal Reserve is actually quite short-lived. He'll be replaced soon. because I don't believe he's a hard money man. I think that any central bank that talks about transitory inflation, as Jerome Powell did back in 2021, is a central bank that doesn't want to tighten. And that's patently obvious for much of the last 2 or 3 years. The Federal Reserve has been basically adding liquidity to the system, although it's been in denial. But that's the reality. Now, if we go on dollar, should we talk about the dollar? Because the dollar, I think, is the center.
Yeah, maybe I would love to talk about the dollar as well, but maybe just one last thing, because one thing I'm hearing as well is in terms of QT, like that's QT, QE, that's like these terms that are being thrown around as well. And some people are like, yeah, we're expecting the end of QT, because they're still thinking we're doing like outright QT, and we might be like, if you look at it, superficially, but I think you and others have also argued that there has been some sort of stealth QT going on, but like what if the Fed is actually considering lowering or ending QT at some point, in 2025? Wouldn't that also then again be kind of bullish for liquidity, or is that the wrong way to think about it?
Well, I think it's certainly not bearish for liquidity, that's for sure. But what I'm trying to say is that there are increasing demands on that liquidity pool. So it's not so straightforward as it would have been in 2024 or 2023. So you've got an increasing supply. I'm not denying the fact that you will likely get more Fed liquidity. I think that's very much the reality. I think you may get more Fed liquidity against a background where there are very few, if any, interest rate cuts in the US. So I think that the Fed's balance sheet will expand again. But let's be clear, what's been going on for the last 2 to 3 years, in fact, principally since October of 2022, is that what you've seen in America is a concept that we have called, or flippantly called, not QE, and that has operated alongside a policy that the Treasury has enacted, which is called not yield curve control. So in other words, they've been denying what they've been doing, but they've been doing it sort of sous la table. And that is the reality. Interestingly enough, Scott Bessent, in his hedge fund, basically identified these threats a few months ago. And he said that Powell and Janet Yellen were basically colluding to get Biden reelected. And what they've been doing is subtly injecting liquidity into the system. And that has buoyed markets. Now, he spotted that. Very few other investment managers, as far as we know, were as that keen on the subject. They weren't so quick-witted. But effectively, what you've seen is this surreptitious easing. Now, how has it been done by the Federal Reserve? It's been done because every item on the balance sheet is not liquidity creating. So the balance sheet may well have been shrinking, but the fact is you've got to identify which elements of the balance sheet create liquidity in money markets and which don't. And what you've seen is the liquidity creating elements in the balance sheet have actually expanded. So the balance sheet may have shrunk in size, but liquidity from the Federal Reserve has increased. Evidence, rising bank reserves. Bank reserve levels are basically identifying the amount of money that's washing around in US money markets, and that's been going up. So obviously the Fed has been injecting liquidity. Second thing is that if you look at what's happened at the Treasury, Janet Yellen has been extremely clever, I would say, because what she's done is she's skewed the calendar of issuance towards bills, Treasury bills, and short-dated debt. Now, why is that important? One of the reasons is that you can technically define liquidity in terms of the ratio between the stock of assets and their duration, that ratio. So if you, let's say, keep the stock of assets the same, but you decrease the average duration, what you're getting is a liquidity boost. And you can see that best in terms of understanding who owns or who holds bills and short-dated government debt. And the answer is it's largely banks or credit providers, because that gives an immediate offset to a deposit that's coming maybe from government spending. And what you see is banks and, banks generally, but banks and credit providers basically increasing their holdings of treasuries and agency securities significantly. And what that is doing is monetizing the government deficit, but it's also helping to bolster conventional monetary aggregates. But this is what's happening. They're subtly injecting liquidity into the system. Now, is there a cost to doing that? Yes, there is. The cost is that more and more of the US government is being funded at the short end. So it makes them very, very sensitive to changes in the interest bill and increasing interest rate. So the interest bill we know now is escalating fast. It's over $1 trillion US. it is slated to go up 20% next year, simply because of the rollover of debt. 30% of US debt is likely to be rolled in 2025. So you get the idea that effectively, what has happened here is that Yellen has made Scott Bessent's job very, very difficult. Now, what does that mean? Does it mean that Scott Bessent comes into the Treasury and he says, enough is enough, we're not going to cheat anymore, we're going to start going to go back and fund at the long end? Well, I think if he did that, it would be a disaster for Wall Street. It would take a lot of liquidity out of markets and it would upset his boss, Donald Trump. So I don't believe he's going to do that. I think he's going to run with this policy for longer, but I think he's going to put a different person in at the Fed, or engineer a different person at the Fed, somebody who is a lot tougher on inflation and more of an inflation hawk. And so he can basically forward guide the markets to a view that they are anti-inflation, but at the same time, they can allow the balance sheet to expand. That would be my view of what's. But it also means a strong dollar.
Yeah, exactly. And just to add up to this, is this also related in terms like we've recently seen, like if we see or from the Fed minutes, when we take a look that the Fed is reconsidering like lowering the award rate on reserve repos, on the reserve repo facility to kind of push capital out of the remaining capital that's still in there. I think it's about 200 billion, and we've been hovering around this level for quite some time, as far as I'm informed. And they maybe by doing this are trying to kind of push the capital out of this facility back into the market, sort of like improving bank reserve liquidity, which then could also be serving as a sort of absorber for the debt that you just described. Is this connected at all, or what are your thoughts there?
Yeah, I mean, it can be connected. I mean, the fact is that what we can see from everything I've just described is that the Treasury and the Fed, not only are they working closely together, but they're absolutely focused on liquidity question. To say that liquidity doesn't matter basically, denies what policymakers have been doing for much of the last 10 years. They've been absolutely focused 100% on liquidity question. This is key. It's key to understanding these markets. And the fact that they are reducing interest rates on the reverse repo is basically saying that they want to run that reverse repo down as much as they can. So that will be a source of liquidity going to markets. On top of that, you've got something called the Treasury General Account, which is the Treasury's holdings of cash deposits at the Federal Reserve, money that is not circulating, if you like, yet. And if they run down that Treasury General Account, which I think that, they will be forced to do ahead of the debt ceiling reimposition on January the 2nd, that will be something like $400 to $500 billion dollars injected back into financial markets. So I think you have got very good grounds for arguing that liquidity is coming in. And the reason I think they're doing that is they can see that banks are probably struggling with reserves at where they are now at about $3.25 trillion. That is not sufficient to keep this system running. There's a risk of financial trouble if it gets much lower. The other thing they did, which has not got very much publicity at all, surprisingly, is they changed the rules on bank stress tests. And what they did in August was allow the banks to basically use more and more Treasury collateral to borrow, whether it's from the discount window or from the standing repo facility, or they could borrow from the Federal Home Loan Banks. All these things basically are saying that banks can hold more treasuries, and please do hold more treasuries. We'd rather like that. But these are, if you like, bending the rules to get more liquidity in the system.
It's just another way to engineer financial like debt monetization, as you described just elegantly. That's exactly it. Well, I mean, when we come back to the dollar, like there's the strong dollar or the weak dollar, whatever. I mean, what's that change of heart by Trump? Where did it come from? Because I feel like, as you said, like he was rather known for having a weak dollar. I also think like Vice President J.D. Vance, when he was kind of introduced, like a lot of people were citing like talks that he has given that where he was absolutely like vouching for a weaker dollar. But why now it seems like dollar or Trump and his administration is going for a stronger dollar? At least like in the past few weeks, it has looked that way. Why the change of heart?
Well, I think the first thing to say is that a lot of the policies that Trump is enacting are basically pro-dollar anyway. So let's be clear about that. Scott Bessent very eloquently said recently that actually Trump's policies are deflationary, not inflationary, and I basically got some sympathy with that. That's probably correct. I think the other thing that you've got to say is that the other point that Scott Bessent has also eloquently made is that if you look around the world at international politics, what you find is that voters tend to kick out politicians that have overseen high inflation. And that must be a lesson for Trump in the upcoming 2026 midterm elections. So if he wants to hold on to the House, even to cement his majority even further, what he's got to do is to control inflation. He can't let inflation run away. And Janet Yellen has basically, made the job rather tougher. And that's why I think that the focus of Bessent and Trump is likely to be on keeping inflation expectations low, which is why I think they're going to not sanction, or they would rather not sanction, the Federal Reserve cutting interest rates too much. And I think they need a tougher Fed chair in there, someone who can actually espouse this or forward guide the markets, I should say, towards a low inflation outcome. So that would be my thinking. Now, in terms of the dollar, as I said, everything is underpinning the dollar, but then you've also got to understand the background here in terms of the trends. And there's a slide that I've got in the pack I sent you, which is entitled Net Inflows into the US Dollar, which is basically a graph that shows the movements of capital into the US over the last 20 years. Now, the point about showing that chart is it's not coming from the US side. In other words, it doesn't come from TICS data published by the US Treasury. This is data which comes from other countries where they're saying what they invest in US assets. And that's likely to be more accurate because the US numbers undercount the inflows into the dollar. And what this basically illustrates is a significant surge of money coming into the dollar, basically after the global financial crisis. Not only is that number positive, but it actually looks like it's starting to accelerate again. And that inflow has been underwritten by a number of features. One is America's technological leadership. One is the fact that the rules on banks have changed. They're required to hold a lot more safe assets and be tighter regulated, which means holding more US treasuries. You've had the Eurozone banking crisis, which basically put a nail in the coffin of the euro as a reserve asset. You've had the Chinese anti-corruption crackdown, which meant a lot of money went out of China into the dollar, etc. The COVID crisis, you name it. Everything has really been pro the dollar. And those capital inflows are significant. Now, if you look at the following chart, what that shows is my preferred measure of the dollar, which is the real trade-weighted exchange rate basket. Real means that it's inflation adjusted. And what you can see here is a situation where there has been a very noticeable trend change around the time of the GFC. Now, I can't see any threat to that upward trend in the dollar, from the data. It's not breaking down. It looks like it's well embedded. That trend is going up. People are investing in the dollar. Now, what you've got to think about is how that mechanism drives capital markets. In the period from the mid-1960s right the way through to the GFC, the dollar was weak. That weakness in the real exchange rate basically came through in terms of monetary policy actions. And what it meant was that foreign central banks could ease. It meant that the Federal Reserve, because it was not really prepared to allow the dollar to, or didn't want the dollar to go up very much, was quite prepared to allow it to fall, was easing at the same time. And so what you had was all central banks were running easy monetary policies against the background of a weakening dollar, right? That was the best time for global liquidity. Global liquidity is abundant and financial assets went up hugely, right? Since the GFC, what you've seen is a very significant change in the dynamics. And those dynamics have basically been, one, where you've had rising real exchange rate for the US dollar. Now, in my book, Capital Wars, I articulated how that mechanism is translated. And what it means is if the real exchange rate is rising, either the nominal dollar goes up and or US prices go up. Now, what we know is that goods and service prices are sticky, and most prices that adjust are financial asset prices. So in a rising real exchange rate environment, you get the cocktail of a rising nominal dollar and rising US asset prices. And that's exactly what we've had. Now, in that situation, the other side of the coin is a falling real exchange rate in the euro area, in Japan, and in China. And what's happened is that their nominal exchange rates have gone down, and or their asset prices have gone down, certainly relative to the US. That's been unmistakable, and in cases in absolute terms too. If those central banks are even more robust in wanting to hold their currencies up against a strong dollar, viz. China, then what they enact is an even tighter monetary stance. And that tighter monetary stance creates huge deflation domestically, and it causes asset price collapses. So what we're seeing here is the absolute clear unfolding of a real exchange rate adjustment mechanism that will keep going in this direction until it doesn't. And what will arrest the rise in the dollar, arrest the rise in Wall Street and the US dollar, is basically some reversal in capital flows and or the Federal Reserve jumping hard on the brake because of an inflation problem. So what ends the US bubble is an inflation pickup, pretty much like ended the Japanese bubble in 1989, when left field, nobody was focusing on inflation in 1989 in Japan because the rice price, which dominated the CPI, was unchanged. Yeah, I think if I remember rightly, in Japan, the price of rice, bizarrely, was 25% of the CPI, and it didn't change. And that kept inflation low. And what happened was Mieno, the central bank governor, decided to tighten policy aggressively because he said service sector inflation was accelerating. Well, no one in Japan had ever heard of service sector inflation before, but that's what gave them the excuse. He hit the brakes hard, caused the yen to spike higher, and a huge deflationary hit to the economy, which it took them 20 years to get over. And that is the background then. Exactly the same thing happened in emerging Asia in the late 1990s. Then it was foreign investors that pulled the plug. And what we're seeing now is the similar bubble unfolding in the case of US assets. As I say, enjoy the party but dance near the door, because this is not going to go on forever. But what you've got to understand is the dynamics behind the dollar. And I think that Bessent wants a strong dollar, and I think a dollar strength is part of their policy. And the final slide that I sent you, I put a little schematic diagram that basically tried to understand Scott Bessent's policy from my perspective anyway. And what that diagram basically illustrates is that what they do is that they undertake deregulation, they undertake increasing tariffs, that underpins the exchange rate. The strong exchange rate brings inflation down, and because inflation is coming down, it makes the funding job much, much easier for the government or the Treasury to undertake. And that's basically the sort of the virtuous circle that you may be seeing under Trump too. If it applies, it doesn't apply and inflation picks up, then then run for the hills.
Yeah, that's a lot to take in, but so interesting. I mean, I was just like now thinking myself, the things that you were saying, and some things that's kind of light bulb that went off is really like, yeah, if we have this situation, that you just described, that it seems to be ongoing, that the dollar is not weakening but strengthening, and there is no real reason to assume that this will break anytime soon, this trend, then as you said, it's the dollar going up as well as US market or US assets. But then also for me, like somebody who's really interested in Bitcoin, I think this is also something that people need to understand. As you said, that the dynamics here might be changing, especially because as I said, historically, it's been the case that if the dollar is strong, Bitcoin is kind of weak, but for the last few weeks, this has not really held. And maybe in 2025, this is not going to hold that much longer. Obviously, we'll maybe have these periods where you have some corrections, because whenever, as you said, then also financial crisis rumors are rampant again, then maybe you get some fire sales and you would have great entry prices again for Bitcoin and other hard assets. But one last point that I want to make on Bitcoin, especially now that you're saying, this US asset market, it's all connected. Now my thinking is, and that's probably also why it now makes sense to me, that a lot of people within the US, also within the Trump government, they have been really vocal on Bitcoin. and Bitcoin is almost becoming a sort of like adjacent asset to the US market, especially if something like a strategic Bitcoin reserve were come to pass. It's the sailor play on the US government where they hold Bitcoin. Then it's even more correlated to US equity markets, I would assume, which would then, in the scenario that you just described, be positive for Bitcoin at least. That's just a thought that kind of was running through my mind now, because they're kind of Americanizing Bitcoin in that sense. And it's probably not in the interest of all the Bitcoiners, but price-wise, it could be interesting for sure.
I think utilizing stablecoin makes all
huge sense.
Yeah, that's as always.
So increase in demand for Treasury securities. I mean, that's got to happen. Anyone who's got any sort of joined up thinking in the American administration has got to go for, formalizing stablecoins role. But I think that, let me be clear. There's no reason why the dollar can't go up and Bitcoin and gold can go up as well. That's for sure. That's on the basis that liquidity in the US keeps rising. And as I say, what's driving the rise in Bitcoin and gold is monetary inflation. What's driving the dollar is increasing capital shifts into US assets. So there's no reason all three can't go up. We've seen a different dynamic historically, but that's for very different reasons. What ends the party is if US liquidity starts to come down heavily. If US liquidity comes down, remember it's cyclical, then you're going to get the dollar coming down, potentially. You're going to get, or maybe a bit later, but you'll first see the gold price collapsing and Bitcoin collapsing. And we know that they're highly volatile. So these are things that really need to be taken into consideration. Liquidity is all important in this equation.
Yeah, great. Well, Michael, I think we've gone for almost an hour, so I want to be conscious of your time. So thank you a lot for sharing all these insights with us, especially with me. It just, as I said, some light bulbs definitely went off again, or on, so to say, that I can kind of like think about and kind of meditate on as well, all these things that you shared with us. So thanks a lot for your time. Maybe just one last question. I was certainly linked to your Substack that you have, Cross Border Capital, maybe your YouTube or X account. But just one last question that I ask to every guest on my show. Is there any interesting people or person that we should be talking to anytime soon, which is, in your mind, a really high signal person that could shed some more lights on these topics? Anyone that comes to mind?
I think I think somebody who makes huge sense in terms of understanding financial markets is Mike Green at Simplicity. I think he's definitely somebody who is well worth talking to. A very clever man and with great insight. So I'd certainly put him high up the list.
Great, cool. Yeah, I heard his name, so definitely we'll check him out for sure. Great, Michael. Thanks a lot. Have a great day, and maybe talk to you anytime soon again.
Look forward to it, Pascal. Thanks for joining me.
Bye. Thanks a lot.